The President of the United States recently issued a stark warning to Iran: make a deal or faced complete demolition. He explicitly stated that every bridge and power plant in the country could be wiped out by tomorrow night. On the ground, we are seeing the direct results of this escalation. The Iranian military is fully mobilized, parading personnel and ballistic missiles, readying their own infrastructure for a major confrontation. This chart shows the total tanker transit calls in the region. You can see a sharp, sudden drop from a stable baseline down to a historic low. This proves the Strait of Hormuz is effectively closed, instantly choking off 20 million barrels of daily oil from the global supply. We have seen what happens when the global economy faces a sudden, total disruption. Back in 2020, lockdowns completely halted commerce, allowing governments and central banks to test coordinated worldwide economic interventions on a system-wide scale. Those interventions were explicitly described by leaders like Klaus Schwab as a rare window of opportunity to reflect, reimagine, and reset our world. Central planners view these global emergencies as the perfect environment to push through sweeping systemic changes. History suggests that when the global economy reaches a breaking point, central planners find a window to rewrite the rules. This oil shock creates the specific instability required to begin the next transition. To understand how this system fails, we have to look at the United States Treasury. The U.S. government is currently sitting on nearly $40 trillion in national debt, an expanding liability that is growing faster than the economy can support. Because the Strait of Hormuz is closed, foreign countries desperate for oil have a problem. Oil is priced in dollars. To get those dollars quickly, foreign central banks are actively liquidating their share of the $70 trillion in U.S. dollar assets they currently hold. This graph shows the 10-year Treasury yield. When foreign nations dump U.S. bonds, the yield, or the cost for the U.S. to borrow money, spikes. Research suggests that if this yield crosses into the red band here, between 4.6 and 4.8%, the U.S. enters a debt death spiral, where bigger deficits require more borrowing at even higher rates. If the U.S. fails to reopen the shipping lanes and retreats from this conflict, the world watches the global policeman lose its power. Analysts compare this to Britain's 1956 failure at the Suez Canal, an event that permanently ended the British Empire's global dominance. Facing a collapsing bond market and unsustainable debt growth, the Federal Reserve really only has one functional option left. They have to step in, buy the bonds, and print money directly into rising oil prices. Unlike the 2008 bailout, where money remained within the banking system, this Type 2 expansion enters the broader economy. Every new dollar created flows into the real world, driving up prices and causing persistent inflation. Distributing a $40 trillion burden requires a new strategy. One theory suggests the debt will be privatized, connecting government liabilities directly to every person on Earth with a smartphone. This is already being written into law. Legislation moving through Congress right now, like the Genius Act, requires that any company issuing a dollar-pegged digital asset, or stablecoin, must back it dollar for dollar with U.S. Treasuries. Instead of asking citizens to trust unfamiliar crypto networks, the government can leverage the brands you already trust. Major technology companies will effectively become banks, offering digital wallets that run entirely on government debt. Imagine loading your car's digital app with cash. The manufacturer takes those dollars, buys you in the form of charging credits or vehicle discounts. Every major airline, retailer, and fast food chain with a rewards app will transform into a distribution node. Your daily purchases will be backed by and implicitly funding U.S. government liabilities. No one is going to force the public to adopt this system. People will happily opt in because the apps are fast, the discounts are appealing, and the integration is completely seamless. But beneath the convenience lies a highly sophisticated financial control grid. Unlike the traditional SWIFT banking network that sanctions entire countries, this new digital system can target specific individuals, completely bypassing local laws. Private stablecoin companies have already tested this capability, freezing dozens of digital wallets. A single line of code is all it takes to instantly cut an individual off from their money due to regulatory flags. That money is fully programmable. Authorities could instruct the network to decline transactions on Tuesdays, limit your travel miles, or block the purchase of energy-intensive products to enforce environmental quotas. Governments seizing or controlling private assets is a documented historical reality. In 1933, President Roosevelt criminalized the private ownership of gold, forcing citizens to hand over their physical wealth to the state. To protect yourself from a tractable digital ledger, you mute assets that exist completely outside of it. Physical gold has served as hard money for thousands of years because it cannot be digitally frozen or easily tracked by a central authority. Holding physical silver serves a similar purpose. Combining precious metals with physical cash allows you to maintain transactional privacy, build local networks, and keep a portion of your purchasing power entirely in your own hands. The financial architecture being built right now is intentionally complex, designed to look like normal corporate rewards programs. But if you understand how these systems actually function, you can choose to self-custody your assets and maintain your financial independence.